Okay, Assalamu alaikum, brothers. Okay, so welcome to the financial planning workshop. I'm Shahjan and Anwar, who are going to be the main experts that you should be listening today. So I want to do a quick introduction, just frame the session, how we're doing it here, what we're doing in the mosque, and some other questions on background really. So I've been mates for a long time, and I've been to a lot of these presentations which are brilliant in terms of financial education, talking about different aspects in the financial world. And he mentioned that he wanted to do something in Hemel, and I said, well, there's not probably the demand for it, and obviously it's wrong. You got to hear the testament to the fact there is interest, so wrong at that point. The second thing I said, well, what's the take on this? Because normally at mosque, what we do is we have muftis and scholars come in, tell us what is permissible and not permissible, and that's the order of play in the mosque. And Shaj said to me, he asked me a good question. He said, well, how do you have financial products? And I said, yeah, I do. And he said, well, you've got a bank account, right? And I said, yeah, I've got a bank account. Is that halal? I said, I think not, maybe not. You've got a pension? Yeah, I've got a few pensions. What are you doing about that? So that whole conversation led me into space, which was, we don't have the information about these financial products, which we don't know if they are halal or they're permissible. We then can't really walk into the space and knowing what to do about them. So these guys are here from the angle that they're going to give you that information, going to give us that information about what the landscape looks like in terms of the products we've got. And the second thing is that Anwar is here, he's an independent financial advisor, is to then be able to get a little bit of information about how to then go into products that are Shariah-compliant and kind of guide us through that landscape a little bit or tell us about it. You may not get every single answer today. You'll get probably a bit of information from the top, and there might be more conversations you have with these guys later on to help you through that. But for me, the main point here today is you're going to get some information, and we're going to make some determination about what to do next. I think what we're all trying to do is that we have products. We're not sure if they're permissible or not, but we need to try and move towards that space. Some have done it already. Alhamdulillah, that's a good thing. I have to admit, I haven't done it 100%. I need to get there, and that's why these guys are here to help you. So based on that, now that Imam's come, I'll have to repeat my introduction. So I think with that, hand over to you guys, okay? Yeah.
Hello everyone. Thanks for coming. We were a bit worried no one would turn up, but obviously we've got a good crowd. So thank you for coming. I'll just sort of run through roughly what we're going to try and do. I'll talk for about 10 minutes, and then we'll get to the main presentation, which is Anwar. Anwar's going to give you a presentation, and then what we'll try and do is get through Anwar's presentation and do Q&A afterwards, and leave plenty of time for Q&A. I think we've got this space until 9 p.m. So there's plenty of time. I think we're willing to stay here till 9 p.m. So don't worry. You can ask more questions. If there's no questions, then you can go home to your wives and kids, basically. But anyway, so without further ado, I'll just sort of do a bit of an introduction about myself. So I've done a few of these, and I end up not introducing myself. So I'm now making sure I introduce myself. It just gives everyone a bit more confidence that I know what I'm talking about, I suppose. So I'm Shahjan Alam. I'm an actuary. I've worked in investment and pensions for the last 27 years. Not advising. I have to point out that I don't advise individuals. That's where Anwar comes in. I advise institutions, pension funds, and insurance companies as well on how to put their investments together to save for the long term for groups of individuals, right? Anyway, having been in the industry for 27 years, you sort of get to a place where you think, okay, I've been doing stuff quite selfishly for myself, really, to earn a living and have a career. But what can I give back to the community? And I'm not a Islamic scholar. I'm not, but what I can give back to our sort of Muslim community is the sort of basics of my knowledge, and get people to think about things, and hopefully help promote the financial well-being of our community. Now, when you're giving a talk to the public and you're an investment professional, one thing you've got to do is make sure that you let people know that this is not investment advice, because you have to be sort of regulated to do that, right? And rightly so. And the other one I've added here is, this is not per se an Islamic talk. It's about finance and the fact that there are financial products out there that you could look at as a Muslim. And so we're not issuing any fatwas. So I think Maulana at the back would be happy that I'm not doing that. I think before I go in, I think one thing that Wazid talked about, the information. I think we all need information to basically make the right decisions around our finances, right? But a lot of the time with these things, all right, with lots of things in life, information isn't enough. It's not just an information problem, right? Otherwise, we could just read all the books the Maulana's read, and we could be call ourselves Maulanas, right? But we can't, because there is a processing issue. You have to be able to process the information. It's really important to know that I could read a book and say, okay, I know everything about this topic in Islam, right? But I don't, because I haven't got the whole sort of outlook and training to understand these issues. So I think it's a sort of thing that just when you were talking, I was thinking actually, information we can give. It's like Moni does the diabetes thing, right? And he talks to people about diabetes, and we give information, but it's also about attitude and processing that information. Well, that's what we're trying to do. So a bit of an aside, but I just wanted to thought that was worth covering. So why is it important, right? Yeah, why is it important? Why am I worried about our communities? So this chart here, it basically shows, compared to the white British household, right? What's the difference in wealth for different Pakistan, Black African or the Black than Bangladeshis? And that's saying that Pakistanis have a wealth of minus 270 odd thousand, less than the average white, so the average Pakistani household. The average Bangladeshi has 200 odd thousand less. So what I'm saying is, as a community, we're not up there, and this has been adjusted for demographic and socio-economic characteristics, right? So it's trying to make it like for like. What average white British household has a lot more wealth than we have, right? And that's a problem, right? Because if you don't have financial strength, as you know, if you have financial strength, if you're strong financially, you can focus on things that are higher. You're not fighting to survive. What you're doing then getting involved in higher level stuff that means you can influence the community more, right? Otherwise, what we're doing as a community is all we're doing is we're trying to survive, and trying to survive is a distraction, right? We shouldn't be in that situation. The median Bangladeshi household has about 1/5 as much wealth as the median white British. That's basically saying that they've got 5 times as much wealth. It's massive. It's a massive difference, right? So this is why I think it's important for us all to think about this, right? And find out about this. This one, I won't spend much time on it, but basically it looks at, the biggest pots of wealth that any household really has is pension wealth and property wealth. Property usually being the bigger one, right? So the top one there, the white British population has property wealth of about 115 grand. So that's net property wealth, right? And then, so after mortgages and, after any debts. And then they have 80,000 private pension wealth. So this isn't taking into account the state, what do you call it? The government, state pension, right? And then look at the Pakistani one. Pensions is really low. Wealth is pretty good, right? Property wealth, but pensions is really low. Look at the Bangladeshi one, right at the bottom there. Yeah, on both counts. I mean, they've got no pension wealth according to this. This is from about 2016 to 2018. I think they did the numbers then. This is from both of those charts are from the Office for National Statistics. And hopefully, I think that they did a census in 2021. There's more figures that'll come out, and I'm going to refresh this. But again, it's just highlighting that we, as a community, we're poorer, and if you're poorer, then you live a subsistence life, right? So I did this a few months ago, I think last year, and I said, okay, I've worked in investments for a long time, right? I've worked 27 years or so, and I thought, well, what have I learnt about investing? And I think the biggest thing is compounding, right? Compounding is this idea that you get a return, right? And then you get a return on that return. So it grows much faster. I don't know, are there any engineers or mathematicians in the audience? Yeah, we call it exponential growth, right? The fact that, you only need small growth, but if you're doing it over a long time, if you get that growth over the long term, it grows massively. So this is an example, right? So I said, okay, I actually started around that time, right? Salary 20K, end salary, I've just made these numbers up really, 7% salary growth. And if I contributed 12.5% of my salary every month and I invested in US equities, then I'd have a pension pot of £830,000. So all of us, so similar ages here, yeah, maybe I'm flattering myself, but similar ages, if you, my point is, if you make small contributions to a pension pot over the long term, what your superpower is the time that you've got, right? Now, some of us are, mid-career, whatever, but we should tell our children, they're 17, 18, 15, whatever, the sooner they start saving and putting little bits and getting into good habits, doing that, disciplined about it, the growth can be massive, right? And we should not lose out on this. It's an Islamic concept as well, right? When you give small amounts, or when you do a little bit every day and build on that, it compounds over time. Knowledge, yeah, health, all these little things compound over time, right? So I'm going to spend a couple of minutes on this. It's not working.
Not working?
I knew I should have used an apple.
No.
There you go.
No apple.
Right. So this is, I don't know, some of you may have seen me do this before, but I was looking at, I've been sort of looking at the halal sort of finance world for a while, right? And I'm trying to think this is an example of what I see happening at a really basic level. When you take away all of the layers of what's going on, I see that people have these days a choice akin to this choice, right? Now, two butcher shops. One says halal, and the guy's claiming it's halal, but you've got a question mark in your head, right? And the other one is, doesn't sell anything. Let's say it doesn't sell anything but pork, right? And that is haram 100%, right? What would you go for? Which one would you go for? Anyone? Go on. No, I want to get. I'm interested. You wouldn't go for the haram 100%. Right. Okay. Yeah. So there's no option of going vegetarian and not eating, right? So that's a good answer, right? That you wouldn't go for that. But what do we, as Muslims, what are we doing these days? Because there are halal options out there, right? We are basically saying, okay, these guys are saying it's halal question mark. Actually, I'm just going to stick to the haram, right? We haven't got the choice not to go for it. Like when I was speaking to Wazir, it was, well, you've got a bank account, you've got a mortgage, you've got pensions, and these are not necessarily halal, right? But we're sticking to that because we think these guys question mark, right? Now, I'm not advocating any products or go for these, but it's just a general point I'm making that's the stark choice is this really, and it's about trust. The question mark is about trust, and my point is we've got to work both sides, the product providers and consumers. We've got to work hard, get the information, have the dialogue to build that trust so that we can have a halal financial sort of ecosystem in the UK that satisfies our needs, right? If we don't, then we'll never have one. We'll always be, doing the haram 100%. And the guy that can help you think through all of that stuff, right, is Anwar. So I'm going to pass over to Anwar now. Thank you for listening.
Shahjan, Jazakallah for that. First off, I just want to say, look, Assalamu alaikum, firstly. Secondly, thank you to everyone for being here tonight. When the brothers here mentioned about doing something on Sunday evening, I thought, no one's going to come on a Sunday evening. I've never done an event or a seminar on a Sunday evening. First time in 13 years. First time ever. So first and foremost, look, thank you for being here. There's a reason why we've called it Introduction to Financial Planning, because financial planning isn't just about investing. Investing is part of it, absolutely. But I'd probably say it's about half. The other half of it is understanding where you are today and understanding where you want to get to in 10, 20, 30 years' time and trying to fill out the missing blocks in between. So today we are going to cover a range of different subject topics, and we're going to sort of dip into each of them. The topics that we cover today in isolation, they are sort of half an hour, 45-minute sessions on their own. So I'm sure we're going to have a huge amount of sort of questions afterwards, but inshallah, the main thing is to give you adequate enough information to start thinking about it and to start considering it for yourself. Now, first off, that's the agenda for today. There is a video that plays, but for some reason I can't get it to actually play automatically, but I've sort of given up on it now. But yeah, so we're going to talk a bit about investments. We've got to consider taxation because you can't think about investments without taxation. Inheritance tax planning is becoming more and more of a problem, and I'll run through sort of what that is and how that works. We'll touch up on retirement, and then we'll finish off with Shariah-compliant investments. There are a couple of other slides that I've included that's not on the agenda. One of them is about scam warnings, and we've seen a lot of that this year. I think we've seen two big ones this year, so I'll run through both of them as well. So by trade, I'm a chartered financial planner. I've been in the industry for 13 plus years now. I've been a personal banker, I've been a mortgage advisor, I've been a financial advisor for the last 7.5, 8 years now. I did advise medics or NHS professionals for about 5+ years. Alongside financial planning, I do black and white pictures, but they're not particularly good. In terms of who we are as a business, Blackstone Wealth, so we provide whole of market financial advice. And the way that we sort of our tagline in terms of what we do is we're independent financial advisors, but we specialize within the Shariah-compliant investment space. Now, for me, that was, I'll run through quickly a bit about my journey and why that Shariah-compliant element is so important to me. So I started in the industry as a personal banker working for Nationwide back in 2011. I remember it must have been about 2012, I went to Eid al-Fitr namaz before work, and the Imam was giving khutbah, and he was saying something along the lines of, if you deal with interest, you're waging war on Allah and His Messenger. And that got me thinking. I went back to work and I'm speaking to a customer about savings accounts earning 4 or 5%, but that sort of planted a seed. And that seed, that seed sort of over the years bloomed into a tree. And when I was working in the branch, there was a bunch of us Muslim brothers, and all of us were discussing it in terms of what we're doing, is it permissible? Should we move off? Should we do something different? And for me, alhamdulillah, I did quite well in my career. I pushed up the ranks, relatively quickly. I spent a lot of time investing in myself, studying. But each and every time I went up a rank, that niggling feeling was still there. And eventually I spoke to Mufti. And I said to Mufti, look, this is my predicament. I want to go into the Islamic side, but I want to find the right time. And I want to utilize what I've learned so far to bring value to the Muslim community. And he said, look, as long as your intentions are to help the Muslim community, then you can go through that. You can go through the conventional, get the experience, and then jump off when the time is right. And that's what I did. That's what we did a couple of years ago. We registered the business. Alhamdulillah, I've been trading for 1.5 years now. And I think what really sort of brought it to life was last week. I was speaking to a client last week, and we're consolidating 7 different pension plans. And I asked him, look, do you have any ethical, religious concerns with investing, like I do with every single person? And he said, look, Sharia, I might do conventional. I want to see what the returns are like. So, okay, fine. Came to the presentation meeting, or came to a follow-up meeting, and he said, look, I'm not sure. So I said to him, well, do you receive interest on your savings account? He goes, no. And I said, why do you want interest on your pensions? Because you're going to live off this money till the day that you die. Why do you want to be eating interest your entire life? And he said, look, fair enough, that's a good point. And he decided to switch into the Islamic variant instead. Sarjan did mention about trust, and for us, I think trust is important for any relationship or personal relationship. Trust is a cornerstone of what we do. We respect clients from all backgrounds, no matter how savvy you are, or if you're a novice to investments, it doesn't matter. We have to support. In fact, I like the people that are new to the industry anyway, because I feel that there's a lot more that we can add in terms of value-wise. Service, we try and aim for good service for all clients. And then from a value perspective, we believe in value when it comes down to our proposition. The idea is to make sure that whatever we offer to our clients, they genuinely do offer value for money. So you price yourself in a way that's competitive or lower than the industry average. So in terms of, look, what do we do? So we help to improve financial awareness. So we do run through the seminars. All sessions, we start with a free session with clients just to try and help them gauge an understanding of their finances. We'll help to establish the financial goals, as I've mentioned before. We'll look at investing in a tax-efficient way, along with taking into any ethical or Sharia concerns that they may have. We also plan for their loved ones. Insurance-wise, there is no, takaful available in the UK. It's only conventional, but if that is a need, then that's something that we can discuss. And the other thing too is to help simplify the complex. I mean, we've got a doctor in the room here. We've got someone else talking about diabetes. Look, I don't know the ins and outs of diabetes. I'm sure there's a huge amount of complexities behind that. But I don't expect them to explain all the complexities to me. I just want to know the bit that I need to know. And we do the same thing when it comes to financial services. And all of that, roughly, is what financial advice is. And we do that with a range of different products. So we look at investments, pensions, protection. On the property finance side, I'm an ex-mortgage advisor. I don't really want to go back into that space anymore. Time-wise, it's very admin heavy. Inshallah, the idea is to get someone on board at some point to then provide the Shariah-compliant property finance advice. But we do have other firms that we're externally that we work with at the moment. So hopefully that gives you a bit of background in terms of who we are and what we do. Now, I wasn't sure where to stick this slide because there's so many different places I could have stuck this, but I thought I'll just stick in the beginning. So ISA and pensions, right? We've heard of them in terms of, in concept, what they are. Can I just ask the room, do you believe they're haram or halal?
I don't know.
Don't know? Okay, fine. It depends on the right answer. Because all an ISA or a pension is ultimately they're just a tax wrapper. They just dictate the taxation of the underlying assets that you've got within there, whether it's cash, whether it's investments. That's what it does. So when it comes to investments then, pensions, ISAs and the likes of that, why do we invest? And it comes back to the point that Shah Jahan was making. It's not about, I'm not here to sell you something that's going to 5x, 50x, tomorrow. That's not the game. It's about long-term planning, it's about consistency, and it's about compounding. But it's important that we do that at an appropriate time. Because if we leave it too late, life just jumps out at us. And before you know it, you're 50, you're 60, it's time for you to retire. If you're looking at your pension pots and your net wealth at that point, it's too late. Realistically, it's something that you need to plan for in advance, because I've seen people either delaying retirement, or I've seen people coming back out of retirement simply because they can't afford their lifestyle. So it's important to understand for yourself, what do you want in terms of your own sort of lifestyle, whether it's 5, 10, 20, 30 years, at retirement, and whether you've got the right provisions to facilitate that. Now, I know today we're talking about investments within the markets, but there are several ways to invest. Investing into a property is one of the most tax efficient investments they can have. You've got no stamp duty, you've got no capital gains tax. You do have stamp duty, but you don't have the loading. You don't have capital gains tax on disposal. And from an inheritance tax perspective, you do get an additional allowance if you have a property that you then give to your direct descendants in the event of death. So it's highly efficient. You can educate yourself. I've spent 5 years post-degree educating myself on this side, and I can testament to that. Education does, it does help push you up your career. We've got a lot of our mothers and wives and daughters that invest in gold. And gold, again, it's not a bad asset to have. Comes with its pros and cons. You can invest in a property, higher risk, potentially higher return, but there are significant tax advantages as well. And the last way is about the stocks and shares. Now, rather than stocks and shares, you can just leave the money in cash. But if you did leave the money in cash, cash devalues over time. So £100 in 2004, in order to have the same buying power, that £100 over the last 20 years would have had to have grown by 72.8%. So unless you're doing something with that money, that's going to depreciate with value over time. If we look at, so for example, the blue line there, that's your CPI, that's your consumer price index, which is a conservative model of inflation. So the CPI we basically use for people that are retired. The retail price index, RPI, is used for people pre-retirement. You do have another one, can't remember what it's called, but it's for people within the rental space. But bearing in mind that, inflation or investment returns or interest, it's not linear, it's compounded, and it's difficult to sort of show the impact of compounding on a 2D graph. But the point that we're trying to make here is, since the 2008 financial crisis, we've been living in an abnormal time when it comes to interest rates. Interest rates have been borderline around 0.5% for the last 15 odd years. Historically, there have been more. But purely looking at interest rates, so the red line is that's your Bank of England base rate. Your savings rate might have been another, say, 0.5% more than that. So if you stuck your money into, whether it's conventional or Islamic savings account, either way, your money, there's no way that your money would have grown to keep pace with inflation. You would have lost money, a significant portion of that, over the last 20 years. So what do you do as an alternative? So cash does have a place in a portfolio. Cash is basically your emergency fund. You keep 3 to 6 months of your net income in cash, just in case something goes wrong. If you have any planned expenditure, you're going to buy a car, you're going to go to Hajj, something like that, you keep that in cash. But anything beyond that, you then want to look at what else the market has to offer. And we've got a range of what we call asset classes. So the next one up from cash, you've got fixed interest. This is your bonds and gilts. So bonds are basically corporate debt-based instruments, corporate IOUs. Your gilts are your government-based IOUs. The corporate bonds are higher risk than the government. Corporate ones are higher risk than the government ones because the government practically guarantees the government bonds. You then got property. So property, we're talking about commercial property rather than residential property. In commercial property, over the last, since COVID, it's been hammered quite a bit because office space isn't used nowhere near as much compared to pre-COVID. So that has been, I think, one of the largest wealth managers in the UK recently. They've just shut down all of their property fund because it's just not offering that level of return anymore. The other thing about commercial property, is if you have a commercial property fund, if you're in a position where markets in a recession, it's difficult to pull your money out, because in order to get your £10,000 out, there needs to be another 1,000 of you or 10,000 of you with £10,000 each for them to sell a property that's worth 10 million. Excuse me if my maths are a bit wrong there, but that's sort of, hopefully it makes the point of how property funds work. We've then got shares, which are equity-based investments. And traditionally, when you think about investments, shares are what people are mostly focused on. Shares have the higher potential for higher growth beyond bonds and gilts and cash, but they are also higher risk. And the last one is your alternatives. So this will be your commodities, your gold, your gold, your wheat, your oil. Even Bitcoin is considered as an alternative. Higher potential for growth, high volatility, high risk. Now, we do have a breakdown of sort of the benefits and the risk of each and every asset class. We've mentioned about cash already. You've got capital protection. But the biggest issue with cash, you leave it there for too long, you have inflationary risk. Inflation erodes and eats away at your money. Bonds and sukuks. So sukuks are the Islamic variants of bonds. So rather than having a debt-based structure, it's done on an equity-based structure instead. And that's what makes it permissible. Now, because it's not debt-based, in the event of insolvency, if a company gets liquidated, who gets the money back first? The people that owed money, the debtors, they get the money back first. Shareholders are much higher up the ladder. So because these sukuks are equity-based, there's still slightly higher risk than the traditional bonds. But either way, bonds and sukuks, they have a lot of interest rate risk. If interest rates go up, your bond or your sukuk devalues. Because what you're doing with a bond is you're basically buying something that's going to provide you a fixed return, 5-6% for argument's sake, over 20 years. If interest rates have all of a sudden gone up to 5%, well, now your fixed rate of 5% for 20 years isn't looking so good anymore, because you can get 5% that's liquid that you can pull out after 3 to 6 months. So for that reason, bonds are highly susceptible to interest rate risk. Property, we've sort of spoke about property slightly already. We've touched on shares, on equities. I don't think I've missed out anything from there. But capital risk, you could lose some of your money. It's subject to market fluctuations as well, as we've seen. But a lot of the time, it comes down to staying in the market rather than trying to time the market. So there's a saying within the industry that it's time in the market rather than timing the market. And the last one is your commodities. So commodities, as I've mentioned before, the one that primarily we see within the Islamic portfolios are your gold and silver. But over the long term, although they're a good hedge against inflation or against equity, they don't provide long-term returns. Equities provide far more high returns than bonds over the long term. So when we do invest for clients, it's about building a portfolio that works for them based on their level of risk that they're prepared to take. So this might be a typical example of someone that's moderate high level of risk. So we have developed market equities, we have some bonds and sukuks with inside that as well. So and the whole sort of rationale behind that is to provide them diversification. If one goes up and the other one goes down, it helps to minimize the risk in terms of market volatility. You can have different management styles of when you invest. So you can have active or passive management. Active management, a fund manager will either pick funds for you or will pick stocks for you. And the idea is that they try and beat the market over the long term. It's difficult to get right. 1 to 2 years, maybe. To try and get it right consistently over 10 years, it becomes very, very, very challenging. And most fund managers don't get it right. Passive is where you just follow the index. So you buy a tracker fund that tracks, the world, UK, US, whatever. You just follow the market in whichever direction that it goes in. You can have regional biases. So I know Shah had a slide about US equities. So you could, invest in US. You've got US focused fund. You've got UK focused fund, Japan or ex-Japan, for example. You've also got something called smart beta or factor-based investing, which has sort of come over from the pond from the US over the last 5 odd years. And it's similar to a passive fund. But the key difference is the fund manager will have they'll have tilts. So they might tilt toward growth stocks, or they might tilt towards momentum stocks. So they'll deviate slightly from the passive allocation. So let's say the passive allocation should be, 60% or 40% US, 20% Europe, so on and so forth. But if they think we think Europe's going to do better, then they might increase the European allocation and decrease the US one. So it's a bit of both type of approach. Now, the amount that you have in equities ultimately dictates the level of growth that you have, but also the level of volatility and risk that you have. So what we've done here is I've just got a portfolio from a firm called EBI, Evidence-Based Investing. And what they've basically done is this is just pure what the market's done globally over the last 20 years. So we can see, if you went for higher risk allocation, so 100% in equities, it's done 187.50%. The alternative 10% equity has done 21.75. But the more equities you have, the more volatile your journey is. Now, for someone that's in their 20s, 30s, you can take a high degree of risk, not a problem at all, assuming you're saving for a pension, obviously. For someone that's in 55, 60 years of age that wants to retire in the next 5 years, then actually taking that degree of risk with a 100% in equities portfolio wouldn't be prudent, because the danger is the closer you get to retirement, you could end up in a recession and lose a big chunk of your portfolio value. So what you want to try and do is, over your lifespan, is try and de-risk your portfolio the closer and closer you get to that moment in time when you start to withdraw your money. And the portfolios themselves, in terms of sort of looking back at the last graph, the longer you invest for, the more essentially the portfolio becomes de-risked on its own. So for example, if we look at the data over the last 50 years, and we get we sort of get 12-month running of the most volatile periods, in any one given year, you could have made up to 75%, you could have lost up to 39%. But the longer that you invested for, so if you're invested for 5 years, I wouldn't use the word guaranteed, but you've got an 80% chance of making more than what you've paid in. 10 years, you've got practically a 98% chance. 20 plus years, it's almost certain you are going to have returns above and beyond what you've paid in. So it's all about, and then the next one sort of re-emphasizes that. It's all about being in the market throughout the entire journey. So this is another example. So if you've invested for 30 years from 1994 to 2024, and you invested £10,000, and this is globally invested, your £10,000 over that 30 years would have grown to £94,000 if you stayed throughout the entire time in the market. If, however, you missed out 5 of the best days, you'd go down by 14,000 to 79,000. If you missed 10 days, you'd have lost another 22,000. If you missed 25 days, you would have lost half of the value that you could have potentially gained. And if you missed 50 of the best days, then you actually would have lost money by investing. And this is the point that we're trying to make about trying to time the market. It becomes very difficult to try and time the market consistently over a longer period of time. So, well, look, that's from an investment perspective. Investments do, and we are going to talk a lot more about the tax side of things, but investments allow you to save for retirement, achieve financial goals. It works as a hedge against inflation, and we can also look at trust-based investments to try and preserve wealth for your descendants, for your children and grandchildren. Now, we can't talk about investments, as I mentioned before, without talking about tax. And I remember seeing an advert with HMRC a few years ago where they said, something along the lines of tax doesn't have to be taxing. Tax is absolutely taxing. And it's important to consider tax as part of your investment planning. There are 3 main taxes we need to be considerate of. So income tax, capital gains tax, and inheritance tax. Stamp duty on shares applies if you're directly investing into shares. You're directly buying UK equities, it applies at 0.5%. Otherwise, on funds or ETFs, it doesn't apply. So income tax, everyone has a personal allowance of £12,500 tax-free. And between 12.5 to 50,270, you pay 20%. On 50,270, 125,140 is 40%. Anything above that is at 45%. You do have a unique sort of taper that applies at 100k. If you have more than 100k, for every £2 above 100,000, you lose £1 of your 12,500 tax-free allowance. You can navigate through that by funding more into pensions. You can bring down your taxable income by funding additional pensions. Capital gains tax, currently 3,000, used to be 12,500 or 12,300 up until 2-3 years ago, but the government progressively reduced that. Inheritance tax, so for some of you, that live around there or St. Albans, that could be a potential concern, and we are going to touch on inheritance tax in a bit. But to give you sort of the complexities of taxation, that's not sort of showing everything on that slide, but each and every investments, they work slightly differently when it comes to, I'm not sure why it's not showing the bottom bit. Whoops. But that's fine, I'll just talk through it. So when you invest money into an ISA, that money is already taxed. So we'll assume it's taxed, it's come from your earned income. So you don't pay any income tax or capital gains tax on the way out. From an inheritance tax perspective, which you can't see at the bottom there, it's inside the estate for inheritance tax purposes. So if you were to die, HMRC's, assuming you're above the nil rate band, above your allowance, HMRC is going to take £8,000 out of that. That's for their coffers. Pensions, on the way in, you get full tax relief. So if you're 40% taxpayer, 45, full tax relief. They'll give you all of that money back. If you have children, they can pay into a pension and they still get 20% tax relief. If your spouse doesn't earn, she can still pay in 20% tax relief. So if you're a basic or non-taxpayer, 20% flat rate for everyone. On the way out, you do get 25% tax free. The other 75% of the fund is chargeable to income tax. Now, pensions, they were or they are outside the estate at the moment, but from 2027, April 2027, that's changing. Pensions will become part of the estate. And to give an example of the magnitude of that, I spoke to a client just last week. His inheritance tax liability at the moment is £34,000. From April 2027, his inheritance tax liability will be £721,000. All because of the pension change. That's all it is. He's got 1.5 million sat in a pension pot. That's why. General investments account, offshore investment bonds, you won't normally see these. These are investment types we might use once we've used up these. But there are pros and cons, there are benefits to it. So with general investments accounts, they're quite liquid. So although they're liable to tax, we can manage the taxation of it to a degree. Similarly, onshore and offshore investment bonds, these are technically life insurance plans from a taxation perspective, but the life insurance is like a byproduct. It's only 0.1%. The main benefit of them is, as a tax wrapper, they provide us flexibility when we invest money for clients. And I know as Muslims, or not even Muslims, Asians or ethnic minorities, we love our buy-to-let properties. I think the thing that we need to be mindful of, and you need to ask yourself, is property what it was 10, 15 years ago, or even 5 years ago. Stamp duty rates have gone up again. You've got loading of 5%. CGT rates, they're higher anyway, but they've not changed recently, 24 and 18%, but historically they were higher for property. They're inside the estate for inheritance tax purposes. You can stick it into a limited company, doesn't change anything. It's still part of your estate. There are two types of assets that are included inside the estate, even if it's in a limited company. So those are if it's an investment company and if it's a property company. Now, some accountants or tax advisors say that they can circumvent that, but that's fine. You can consider it. Ultimately, whether it's inside the estate or not, HMRC is going to tell you after you die, or tell your beneficiaries after you die. That's when you find out whether it's worked or not. No, it's fine. Look, I've spoken to different tax advisors. They've given me different things. That's the fact of the matter. For us, as financial advisors, we don't delve into that. So from a trust-based perspective, we look at trusts that are tried and tested and work. So for trusts that are within the HMRC guidelines. So investments in trusts where the 7-year rules apply, they work. We do have business property relief type investments. And there's 4 or 5 billion pounds within these funds. And they're set up purely for IHT relief. But even then, no one's going to guarantee you that that's going to work, because it's up to HMRC to decide after you've died. And similarly with any of these sort of tax strategies. But yeah, that's not something that we advise on. Yeah. 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 Yeah.
Another thing that I was looking at was gifting.
Yeah.
There's a limit. If you die within a certain time,
correct.
Then tax is right.
Yeah. So we'll run through that, inshallah. So we'll run through sort of gifting allowances, different allowances you have from an IHT perspective. And IHT, you know what? That was actually a really big point of discussion. It became sort of a big point of debate in the last one that we did back in January. Mm-hmm. But to give you a bit of an example in terms of how IHT works, everyone has a nil rate band. Everyone has a £325,000 allowance. If you have a property, a residential property that you give to your direct descendants in the event of death, there's another 175,000. And that direct descendant, it's really, really quite broad. Your children's children, fosters, adopted, there's a whole massive range. So between you and your spouse, potentially you've got £500,000. If one spouse dies and you are legally married, not just a nikah wedding, legally married, then if one spouse dies, the other spouse can inherit everything IHT free. So completely exempt. So between husband and wife, you can have £1 million. Once your estate's more than £2 million, this one here, that 175, that starts to get tapered away. So for every 2 million above, sorry, for every £2, sorry, above 2 million, you lose £1 of your residence nil rate band. So if you are a sole individual, single or divorced, once you get to 2.35 million, your allowance is only 325,000. For a married couple or civil partnership, once you get to 2.7, your allowance is basically 650,000 at that point. Now, this slide, it worked really well, or it does work really well right now to emphasize this, but then in 2027, I'm going to have to make up a different slide. But the point is, so, let's use this example. We've got someone married, 3 children, I should say 3 children, not 3 child, but they've got a portfolio overall of 1.3%. That's what the portfolio is valued at, 50K. So everything here, except for that pension, is within inside their estate. So you've got 1.3. Yeah, sorry. Yeah, BTL is buy to let. 1.3% portfolio value. In the event of death, they have £1 million allowance. HMRC wants £120,000. That's before probate is granted. You've got 6 months to cough up your 120K. If you don't cough up within 6 months, interest gets chargeable at about 7.5%. Sometimes.
So, in the event of death,
Yep.
within 6 months, you would have to pay the 120,000.
Yep.
So, if my partner passed away, I would be lying.
No. Second death. Second death. So you both have to pass away.
We both pass away. It's gone to our children, for example.
Mhm.
They would have to cough up within 6 months.
Yep.
Inheritance tax bill.
Yep.
And if they can't, then
Correct. Yep. Now, if you've got assets within inside the estate, the default rule is that you can't sell stuff. But if you've got, you can speak to HMRC. They may allow a concession for you to sell assets within inside the estate to cough up the IHT tax bill. But the default position is you've got to find the money from elsewhere.
so you can't sell your house.
They may allow you to. That's up to their discretion,
But there's a risk that the house comes out.
potentially. But that's up to their discretion. If it's a house, they may well allow you to sell the property. When you sell the property, it's not based on the disposal value. It's based on what the value was at the date of death. So if a property that's worth £1 million, you sell it for 750, tough luck. As far as they're concerned, it's worth £1 million. Now, scenario number 2, let's say this person unfortunately gets divorced. Still 3 children, assets are still exactly the same. Now, because their allowance, they had £1 million, now they've only got £500,000 now, because they don't have the spousal's allowance anymore. The IHT liability is now £320,000. So again, their children need to cough up 320 before they get access to the rest of the money. Now, pension was amazing is amazing at the moment, because pensions, so if we flipped around the buy-to-let and the pension, and we said, look, the pension's 750 now, buy-to-let's 100K, well, actually, because the pension is not part of the estate, it's set up in trust by default, it's not considered for inheritance tax purposes. So your net estate value is 650 grand for IHT purposes, which basically means your liability is 0. You don't need to pay anything at all. However, as we said before, this is changing from April 2027, and pensions are within scope of inheritance tax. 40% IHT. So should have mentioned that. So anything above the allowance, I think I did. Anything above the allowance, 40%. So you're literally paying for another kid called HMRC. but that's basically what it is. So
everyone who's got a pension pot right now,
Yep.
who will retire in 10, 20 years' time,
Mhm.
they're going to have to pay 40%.
if you're combined, you're above £1 million on second death, then yes. And the other thing to add, like this nil rate band, right? This £325,000, that's not changed in 20 years. 20 years, that's not changed. So it's meant to increase in line with inflation. It hasn't. If it had increased in line with inflation, it would have been worth about £510,000 now. The residence nil rate band, 175K, that was introduced in 2017. You went up by 25K every year. Since 2021, that hasn't changed. And none of these allowances are going to change up until 2030, I think. There's still a number of years before. And then even then, they said, oh, it'll go up with inflation. Well, they've said that for the last 20 years, and it hasn't. And they've just extended the freeze. So whether it is going to go up or not, who knows? So and this is my point. Look, I've got a client, very high net worth, alhamdulillah, brother's done very well for himself, very smart. And he's itching to invest. He's like, he goes on to these seminars from people, and Sarjan made a valid point. It's not about reading a book and doing the studies, it's about actually understanding it and doing the job. He's gone on to a seminar with some guys who've read the book and they think they know it now. And he's itching to invest. And I'm saying to him, look, you've just got to hold fire. You've got to hold fire. You've got to let me do this properly. Because if you invest into your ISAs and all of that type of stuff, all you're doing is every 20,000 you're giving 8,000 to HMRC. So let me do it in a way that makes it as tax efficient as possible. Not just income tax efficient, but IHT efficient as well. And then we sort of move on to planning for retirement. Now, a lot of us sort of don't think about retirement so most of my clients don't think about it up until they get to their 50s. And it becomes a bit too late to have any meaningful changes at the age of 50. Now, this QR code takes you to the state pension website, by the way. So if you wanted to look at what your state pension age is, but generally it's going to be between probably 67, 68 for everyone in this room. So if you're born before this date, yours will be 67. Anyone else will be 68. Now, the way that the state pension works is based on credits. The maximum credits you can have is 35 years. So 35 years worth of credits. If you go above 35 years worth of credits, you still pay national insurance and you get absolutely nothing for it. It just goes to the government. And what you're doing for that 35. Mm-hmm. So the reason why we say credits, I mean, it's the word that DWP uses anyway, but credits can be achieved not just by NI contributions. So you can receive credits via non-national insurance contributions. So, you've got your primary threshold, you've got your what's known as your lower earnings level as well. So if you're above that, you don't necessarily pay, but you get the credits. If you're someone, let's say you're earning 60 to 80,000 pounds, right? Before he's 50, but 60 to 80,000, and you're thinking, well, I don't need a child benefit. I'm going to have to give it back to them anyway because they claw it away. Once you start earning above 60, above 80, they take the whole thing away. So you're thinking, well, what's the point of me receiving it? Because I'm going to have to give it back to them. But one of the benefits of receiving it, or at least claiming it, not necessarily receiving it, is your partner, your wife, can still get national insurance credits for up to 12 years. So she can still accrue a state pension purely by having child benefit or claiming child benefit, but not necessarily receiving it. Yeah. So you've got 35 years worth of credits. Once you get to 68, they give you £11,500, which is, simplistically, let's say it's about £1,000 a month. I think it's about 949 something. Are you happy to work till 68? Question number one. Is £949 enough for you? Question number two, that you need to ask yourself. Brothers nodding there. And look, if it's not enough for you, then you need to think about it. So this is something called the Retirement Living Standards Survey. This was conducted a few years ago, I think 2019, might have been a bit later than that. But they basically looked at different types of lifestyles in retirement and the amount of income that you need to sustain that type of lifestyle. So if you're someone that's living outside of London, you want a couple that wants a moderate lifestyle, you basically need about £3,500 a month, or I think that's just under £3,000 net after tax a month. Might sound a lot, but you've got to factor in, you've got your ad hoc repairs, your cars, buying a car, you're going on holidays, all of those types of things included, you need about 34,000. Now, some of it you're going to get from the state pension, because assuming you've got full credit, you'll receive that at 67, 68. But if you say, actually, you know what, I want to retire at 60, well, you can't get your state pension. You've got to have something else in place. If you say, actually, so this scenario, husband and wife, your state pension's enough at 19,900. And I've seen people living off in retirement 750 quid a month. I've seen people do it. Completely shocked, but people do it. If you're one of them, alhamdulillah, that's fine. But if you want more than that, then you've got to plan. You've got to make sure the provisions that you've got in place provide you more than the basic standard of living. State pension isn't designed to make you comfortable. It's designed to allow you to survive. That's it. Nothing more than that. But we can, we've got different alternatives, different ways of making provisions for retirement. And the reason why we talk about different assets, another really, really quick story. Couple, this a few years ago, couple, and they had investments, pensions, ISA, general investments account, investment bonds, a whole bunch of different things. Amazing. It's fantastic because it gave us the flexibility to withdraw it tax efficiently. Between them, they're paying a couple of grand in tax each and every month. And just by moving stuff around and taking different amounts of income from different sources, we got that tax liability to nothing. All because just by using different tax allowances. And that's the importance of having flexibility in different asset types. But you can fund it from cash. We've mentioned the state pension already. You can fund it from that as well. Investments go hand in hand with pensions because pension is taxable, £12,500. Investments, as we've seen before, they come in loads of different tax wrappers. And we can use those different tax wrappers to basically leverage the taxation of your income in retirement in order to make it more tax efficient from a withdrawals perspective. But we've got to take it hand in hand with the whole inheritance tax situation as well. Personal pensions, so even if you have an employer pension, you can still fund the personal pensions as well. Rental property, so I've seen loads of people do this, rental property to fund retirement. It's okay at the age of 60, maybe. At the age of 70, what they typically start to do is panic. Because now you got yourself in a situation, you're worth more than £1 million. You can sell it. You got to pay 24% CGT now if you sell it. If you then die within the next year, within the next 3 years, you then pay another 40% on top of the 24%. So compounded, you lose about 60% of value. So what do? Do you sell it? Maybe you just die with it and just pay 40% to HMRC. Because if you die while holding onto an asset, you don't need to pay capital gains tax. Capital gains tax dies on death. Inheritance tax doesn't. So you've got to pick the lesser of two evils. You've got to do something about it. And that's where sort of the tax advisors come in. So we sort of sit in between legal and tax. We delve a bit into tax. We don't do your tax returns. We delve into trusts. We don't write your will. The last thing, and this worked in the last generation, or you're still working, family, you rely on your kids. What's that going to look like in 10 to, when we have our own kids? I asked my daughter, I asked my son, he goes, yeah. One day he said, yeah, absolutely. He's 4 years old. A week later, he changed his mind. And my daughter's already saying, no, you're not going to live with me. So, you've got to ask, do we have the same provisions? Alhamdulillah, my parents are both alive. And there's 6 of us. And I said to my parents, look, you will always have a home, no matter what happens. For me to look after you, it's an honor for me. For everything that you've done for me, it's an honor for me to look after you. But I think we have this hybrid mentality that's sort of rubbed off from the previous generation leading into the next generation. You've just got to ask yourselves, what position are we going to be in? So I know that for myself, I won't necessarily feel entirely comfortable to rely on my children if I can make the provisions myself, or at least some way towards it. I'm going to touch on Sharia in a bit, so Sharia investments. And this is the whole reason why I did it, while we set up this business. And I spoke to Muslim financial advisor, and I remember 2-3 years ago, and I said, look, this is what I'm planning to do. And they thought I was crazy. Because why would you focus on Muslim clients? Because we are behind the curve. Look, admittedly, we're behind the curves from a financial literacy perspective. So there's more of an educational need, number one. And then number two, net wealth. As Shah Jahan has said, we are more poorer than our white British counterparts. And it's only 5% of the market. But my angle's been, if I make that 5%, 100% of my market, then actually, you know what, there's quite a relatively big market for me. And that's the reason why we did it. So Islamic investments, 2 things we need to consider of. You've got quantitative screening and qualitative screening. Qualitative screening, first and foremost, any non-permissible permissible sort of assets or investments within the portfolio. So any business that's fundamentally in one of these things, they are, I just realized the G's missing from the gambling, but any one of these are screened out from the investment first and foremost. Once that screening is done, we've then got the qualitative screening, which is sort of more ratio based. So these standards were developed by IOFI, which is an international organization, non-for-profit, and they've basically devised Sharia ratios that everyone works with across the world. There's 3 factors: debt, So it's not highly leveraged. So debt is less than 33% of market cap. It's not a cash hoarding business. So it doesn't have high cash interest or bearing items. Again, less than 33% of market cap. And the last one is if it is a business that's fundamentally permissible, but it has an element of non-permissible activity, as long as that element is under 5% and the dividends from that 5% is subsequently given to charity, that is considered to be permissible as well. So you take an example of a supermarket, most things are okay, but your alcohol and your poultry aisle isn't necessarily, as long as that's under 5% and that's given to charity, then fundamentally that's okay. So that does then leave us, you've got, I don't know, look, don't blame me, I don't know why that's moved there, but it was okay when I was at home. But you've got your cash, a cash, you'll only have a small amount in the portfolio anyway. Sorry? The hidden cash. Yeah, the hidden cash, basically. You've got your sukuks, which is your Islamic variant of the bond. Commodities, you'll have a small amount because gold works as a hedge against equities. But if you look at long-term growth, equities provides far higher growth than what gold ever has. And then finally, you've got the Shariah-compliant equities. If we look at in terms of performance, so if you look at purely just the S&P 500 in terms of from a Sharia perspective and conventional perspective, well, actually, looking at it over the last 5-year annualized return, the Sharia portfolios have done better than what their conventional counterparts have done. But the thing that we need to be mindful of is when you're selecting a Sharia portfolio, you are looking at a smaller basket of goods. You've got less stuff to invest in, which potentially that could increase the volatility, so how much it goes up and down. And it could potentially impact the growth because there are certain sectors that you don't have access to. You don't have access to financials. Financials tends to be more of a steady growth opportunity, financial sector. Obviously, we don't do defense. Absolutely, that's another one, which unfortunately, the last year, we've seen, I don't want to talk about returns, but you know what I'm saying in terms of defense for the last year. We've seen a lot of usage of that against our own Muslim brothers and sisters. So smaller basket of goods, but because of the push with tech-based companies over the course of since 2022, actually the Islamic portfolios, which are more have a higher amount of tech-based stocks, they have done a significant amount better than conventional ones. But when you do invest, there are several different ways that you can go out to market, and I've tried to condense this as much as possible, but there's so many different things to consider. So you can do it yourself. So you can go through AJ Bell, you can go through Hargreaves Lansdown, you can go through trading to multiple different providers. But you've got to understand the pros and cons, and they all have a place. Your robo-advisor, that's the likes of Wahid. They have a place, we have a place. So I've got clients where I provide advice to, but then they do DIY stuff with another £2,000, £5,000 that they mess about with. Perfectly fine. But if everything that you're doing DIY and the fund managers can't get it right most of the time, you've got to ask yourself, do you have the time and the knowledge to do that yourself? But it is possible to look at investing via DIY platform. But then you've basically, it's up to yourself to make sure your tax wrappers are right. You can do individual stock selection, but that is higher risk. Going a fund-based approach is far easier. And it is also the most cost-effective way to get into investments. So if you want to trial it, you can go via DIY platform. Robo-advice, smaller pool of investment opportunities. You get a good range of wrappers, but the problem with the wrappers is, do you know how to use it? That's the other issue. If you're only doing £5,000-10,000 into an ISA, you could do that with the likes of Wahid. And they don't have their low minimum investments are relatively low as well. Where we come in is we have a larger range of investment funds. We won't necessarily use all of them for one reason or the other. So we will look at the most appropriate ones. When it comes to tax wrappers, we will advise in terms of the best way to do it. You can do individual stock selection, but that's only if the portfolio is worth more than £250,000. Then we hand it off to a DFM, a discretionary fund manager. But for us, we do have a minimum. Ideally 50,000, but we do go as low as £25,000, and that's between ISAs, cash, and pension funds. But then we do then consider the whole tax position of it, and that's, like I said, that's half the job. So it depends on where you fit. If you're someone that's starting off new, you want sort of a handheld based approach. You can go down the robo-advice route. It will cost you more for that privilege. You'll have a smaller selection, but you know that the risk is done, the due diligence is done, and everything's permissible. The DIY platform, probably someone that's a bit more experienced maybe, start to look into that. But in terms of what's available from a Sharia perspective, it's not always certain. Now, I don't like to put up names of other people because it's not nice. But so this is all from public knowledge. As Muslims, this year we've suffered 2 significant scams, and in fact, there's been a third one in Australia about 3-4 days ago. I wouldn't call it a scam, but some home purchase plan, Sharia home financing that didn't go to plan. But in the UK, we've had one that's had a scam warning, which was Shakur Investments, and the other one recently, you might have heard of Muslim Pioneer, was another one as well. So when you are investing, if someone is saying, I can give you 10% return with 0 risk, so we have something known as a risk-free rate of return and the risk premium. Your risk-free rate of return is what you'd get on a gilt because it's government backed, or maybe in a bank account, you get your 5%. If someone's giving you 10% with no risk, you've got to question where the other 5% is coming from. If it's no risk, how are they providing you that? Number one. If they are then providing you consistently high returns, 20-25% each and every year, you've got to ask the question again, where is that coming from? Because they can get a commercial loan, or they can get equity partners who charge them far less than that. Why would they come to you and pay you 25% if they can get it less than that elsewhere? If it's if it looks too good, if it looks too good to be true, it probably is. Check the FCA register. If they're not registered with the FCA, something goes wrong, that's down to you in court. There's no one else for you to complain to. That's how you're going to resolve it. If it's a limited liability company doesn't have assets to pay, tough luck. As an IFA, we don't handle client money. So if you invest, it goes from us directly onto the investment platform. And most other IFA should work within that principle as well. And the last thing that I'd say is, do you understand what you're investing in? I've seen companies that do VCs, venture capital, which are higher risk, and doing that, providing it to the lay Muslim. Are you familiar with what you're investing in? Are you familiar with the amount of risk that you're taking on the investment that you're proceeding with? I think I've been warned about timing, so I'm going to the next few slides. We are changing websites over the next month or so. So if you do go onto our website, you are going to see a warning at the moment, but it's been shut down in about 2 weeks' time and replaced with a new domain and new website, inshallah. FCA registration isn't changing, contact numbers isn't changing, email addresses won't change for another 10 months, but will be shut down in September. And the last one I'll sort of wrap up really. And I'll run through this quickly. So in terms of what we do, how we work, we provide everyone a 30-minute call first and foremost to understand the circumstances, to see if we can be of benefit to them. If we can, we'll book a financial review, no cost to that, which will run through all of your circumstances in more detail. And we'll say, look, these are the types of things that you need to look at. If you're then happy to proceed, we'll then go away, gather the relevant data that we need, and then we'll arrange a time for us to come back and present our recommendations to you. If you're happy with the recommendation, we then move onwards, implement everything, and then we have the option to then come back and review your circumstances on an ongoing basis. That's the end of that. I will welcome any feedback. If anyone does want to book a call, then get in touch. But any questions? I know the brother was just here about IHT. I think hopefully he'll come back. But anyone else have any other questions? Yes, please.
Okay. Your scenarios of the 3 scenarios that you had and and whatnot.
Yep.
And why to let portfolio. I'm going on the assumption that that's on a personal name.
So, like I said before, even if it's a limited company, that in itself doesn't make a difference from an IHT perspective. So,
but the company in itself is not a personal asset. It's a company asset.
Yeah, I know. Company legally, like a trust, a company is a separate entity to you, right? Legally. Doesn't make a difference.
So nothing is being sold. So I've died. I was a director. Now my kid becomes the director of that company. Company carries on running.
So for IHT purposes, expressively, 2 assets are excluded. They will still be considered. So a limited company that holds property is still part of your estate. The fact that you've transferred it into a limited company, that doesn't change anything from that perspective. Now, it does give you more flexibility in terms of income withdrawal, because you now have, dividend allowance and dividend tax rates and all of that, those types of things. You do get that. From an IHT perspective, fundamentally, there is no difference. Now, like I said, I've spoken to different tax advisors, and when it comes to sort of buy-to-let property, IHT, we stop at that. We don't cross over that bridge. But I've spoken to tax advisors. Some of them say they'll charge 15 grand to move it into a limited company, set up and wrap it up into a trust and all sorts. And that might work. But I've spoken to other tax advisors saying that you'll get, in terms of the capital gains from the property, will be chargeable at CGT rates rather than income tax rates. But from a actual IHT perspective, it doesn't work. I don't know. And that would be might be considered as a gift then, as long as
they're on the board of directors,
and
then he resigns.
Yep.
Then he's stepping down.
Yeah. So again, you need to get some tax advice on that, but I would assume in that instance that would then be considered as a gift, in which case then the 7-year rule would apply. And after 7 years, it's then considered outside the estate. Yeah.
Another question.
Yeah.
I don't know how long we have. So another question. On
Yeah.
ISA. That's fine. So
Yeah.
on ISA side,
Yeah.
so you're allowed £20,000
Yeah.
ISA.
Yep.
Correct me if I'm wrong. My understanding is you can invest up to £20,000 per year
Correct. Yep.
on an ISA platform.
Yep.
Head covers running.
That's fine. Yep.
If that £20,000 over the next, let's just say I'm consistent, £20,000,
Mhm.
and that £20,000 over 30 years
Yep.
turns out to be X, whatever.
Fine.
Right?
Yep.
Is there tax liability on that?
Not on withdrawal. So on disposal, you take that money out, you're going to spend it on something. There's no liability, but it's still subject to inheritance tax. It's still part of your estate for inheritance tax purposes. So,
100%.
bad idea. Ferrari's a bad idea. Ferrari's a bad idea.
Lamborghini.
No, that's a bad idea as well. So what you want to do is you want to have assets. And the brothers left because there's some really useful stuff about gifting and that. But what you want to do is not have assets that still have residual value. Because if you've taken it from cash and you just bought a Ferrari, all you've done is just move it from one thing that's liable to IHT to something else that's liable to IHT. What you need to do is really, and you've got to be careful because you've then got long-term care elements as well. But from an IHT perspective, if you spend that money on holidays and experiences and stuff like that, then that's okay. If you're going to care, or if you're potentially going into care and you're doing that, then the local council can argue that actually that's a deprivation of assets. You deprive us of that money to fund your care. So that's a whole different sort of situation there. But allowances from an IHT perspective, everyone has a £3,000 gift allowance each and every year. Not a lot, but here's what it is. You can carry forward 1 year's allowance. So you can have £6,000 if you've not gifted something the previous year. You can gift £250 to any number of people, but that can't be mixed with the 3,000. You can gift to individuals, right? If you gift directly to someone or into a absolute trust, which is a trust that has an absolute beneficiary, i.e. this money is definitely going to go to this person, then there's no limit. As long as you survive for 7 years, you're okay. If you gift into discretionary trust, ideally you want to keep it under 325,000. Anything above that attracts tax at 20%. So, but that's a whole separate discussion. Yeah. Sorry. One more thing. I forgot to say. One more thing. If you gift, and this is really useful, if you gift on a regular basis from your income, so it can't be from capital, from your income on a regular basis, doesn't impact your living standards, right? That money could potentially be outside your estate straight away. No 7-year waiting. Sorry, money.
So my scenario is fast forward whatever number.
Yeah.
A lot of us can have children.
Yeah.
My son-in-law comes to me that I want a Rolex. So I buy a Rolex for 10 grand or whatever it is that he wants.
Yeah.
So that's gifting.
So, all right. So in that scenario, what you might want to do, so you do have a wedding gift allowance of £5,000 per person. You've also got £3,000 standard, gift allowance as well. So potentially Between the two, you've got £8,000 allowance for you, 8,000 for your wife, 16,000.
You know, an Asian wedding, every day out. Cars,
Yeah,
furniture.
yeah.
So how does the tax man not pay?
So so when you die, you've got two scenarios when you die. So you die with a will, where you have executors. If you die without a will, you die intestate. You have administrators. It's their legal responsibility to total up your estate and pay HMRC what they're due. So the more better your accounts of everything that, this is all of my stuff and this is what I've done, the better your accounts, the more easier their job is. If they get it wrong, it comes down to the executor's legal responsibility.
Say you've got 3 daughters that
Hmm?
you bought these
Yeah.
and they wanted furniture. You're not going to tell them.
Yeah, so I mean,
This could be sort of above the.
I guess that's the other thing, right? If you're buying furniture for them, you're not necessarily gifting money to them. So you're not gifting them cash, you're buying furniture. So it's like a similar thing in terms of if you're taking them on holiday versus giving them the cash to pay for the holiday. Yeah.
I'm keeping my legs. I'm just buying to avoid. I use it to avoid tax.
General question.
Yeah. 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 Yeah.
Very rarely.
Yeah. Yep.
What's the impact of them having legally recognized as marriage?
Yep.
Legal system. What happens? Allowances are not the married couple allowances, they're individual allowances.
So unfortunately, in that scenario, effectively, inheritance tax becomes due on the death of the first spouse. So in order for the second spouse, nikah only spouse, to inherit it, they need to pay what's due. Equally, if they have property outstanding, mortgage for argument's sake, if it's a residential, so I've had situations where we've had residential property, husband dies, wife's a homemaker, £20,000 left in the mortgage, but they don't have any money. Unfortunately, you've got to cough up the money. If it's not affordable, then it's not affordable. You've got to sell the house, or you've got to find the money from somewhere else. That's it. If it was a joint mortgage, on the other hand, it would have just transferred to the other person. Even if they earn nothing, it would have just transferred over. So that legal marriage, that's of great significance. I will need to go back to that Rolex. I'll need to look into that.
Yeah,
If you transfer a Rolex, I'll need to look into that. Yeah. Well, that's what I'm saying. That's what I'm saying. That's what I need to look into. Yeah. Yeah. Yep.
Buy a house.
Mhm.
Are you getting taxed on that drawing out the pension?
I mean, that's a whole different ballgame. That's two different things we're talking about. Because if you're taking money out of a pension to do it and gifting.
Yeah, because if the pension's going to fall in within the asset.
Yep.
Your estate.
Yep. So with pensions, you got, like I said, 25% tax free, 75% chargeable to income tax at your marginal rate of tax. You can pay 20, you can pay 40, all depends on how much you draw down. So you've got to pay income tax on the pension from that taxable pot. When you've then given it to your children, now this part gets a bit grey because we've got to distinguish between income and capital. On capital, 7 years. Income, if it's regular from income, doesn't impact your living standards, is straight away. Now, HMRC, there isn't a clear definition of what income is and what capital is. So I think when it went to court, I remember reading a court case from a couple of years ago, he was saying, if you take 1 year with another year and the gifts that you've made are consistent and they're from income, then that could be considered as a gift from income. But if it's an irregular gift, just a one-off that you've made, then that'll be considered as capital. The thing is, with like even inheritance tax relief investments, no one gives they don't give a rubber stamp beforehand. You only find out when you're dead. Well, you don't. Your children do. Yeah.
Cryptocurrency.
Yeah.
Tax on crypto. How does that
Oh.
yeah. Something just changed recently.
That's not on my street. I think Ayn that sort of does that. He knows a bit more about crypto. As far as I'm aware, I think it's subject to capital gains tax, CGT. And that's the only tax I can think of because it's not earned.
Gains,
yeah.
But at what threshold?
So capital gains.
40%.
I don't know.
Which again is a bit harsh in the sense that you risk 100%. Taxman says, "Oh, thank you for making a few million. They
don't want you to use it though. They don't want you to use it. They just want to make it more. It's decentralized currency, right? They don't have oversight. They don't have control. They don't. They're going to come up with all this nonsense about money laundering, terrorist financing, all this rubbish. Reality is loss of control. They don't want you using it. That's what it comes down to. But in terms of taxation, I'm not fully clued up on that, unfortunately. I think Einbuy might know a bit more about cryptocurrency, but I can't imagine it being 40% because unless they wouldn't consider it as income because it's not earned money. It's a
risk.
Yeah,
100%. Like if I was to raise say £50,000 in crypto, it can go to zero.
Yeah, absolutely.
But equally, 50,000 can go to $1 million. And so why does the tax on right
that's just like any other. Yeah. If you buy shares, it could double or go to zero. So that argument isn't.
You said about there was no tax on that, right?
What's that on
stocks and shares?
On ISAs, there isn't.
If you put it in an ISA,
so if you're buying it,
so if you could buy Bitcoin in an ISA, then there wouldn't be any.
You can. Yeah. So Bitcoin, you can. So there is BlackRock launched a Bitcoin ETF not too long ago. So this was in the last 6 months. They've launched a Bitcoin. I mean, it's been funded by I think tens, if not hundreds of billions already. Yeah. So you can get exposure to an ETF potentially via an ISA, and then you still get the ISA allowance as well. I mean, I've not personally looked into it, but in theory, it's definitely possible. Yeah. Assalamu alaikum.
Really helpful. Just almost the polar opposite of the conversation we're having. You had a really helpful slide, which said basically in regards to inheritance tax.
Yep.
If I understood it correctly, you're married.
Yep.
Then £500,000 is.
Yep.
Up to £500,000 is inheritance.
Yep.
Yeah. So with respect, the discussion is for people who have is it million? So if you're married, it's $1 million. So it's 500 each.
Mm-hmm. Yep.
Sorry, now you go. That's how Mrs. will get. Finally, my Mrs. very, very rich.
Yeah. So good.
So even more to the point, I think that's even more to the point. The conversation we're having is specifically for people who have a portfolio of over £1 million.
Yep. It's going forward. I mean, historically, pensions and from the slide deck we saw before, pensions, potentially there's a huge amount of wealth there. And I think, when we looked at the ONS numbers, there is some, we've not sort of discussed why, but I think the reason why we have such low amounts in pensions, part of it is because of the legacy in terms of our fathers and our forefathers. A lot of them were manual workers, right? Low skill paying jobs. Income wise, maybe, we were a bit liberal in terms of the amounts that we earned. So then we didn't really get much in terms of pension funding. But our generation is, alhamdulillah, brothers are doing amazingly well. So we will have a lot more pension funding than what the last generation have had. And we would then run into the same problem from an IHC perspective, because from April 2027, once you include the pension pot, all of a sudden, you're within that £1 million sort of combined bracket. Yeah.
You mentioned offshoring.
Mm-hmm.
What's the benefits?
Offshore. So.
Offshore investments.
Yeah. So I'll give you a prime example. I've got a brother, I said before, very, very, very wealthy. He's planning to move to Abu Dhabi, within the next few years. Huge inheritance tax liability. One of the things that we're talking about is you don't really want to grow wealth in this country, because the danger of growing wealth in this country is, firstly, ISA allowance of 20,000 for someone that's worth 9 million doesn't really do anything at all. So that's the first thing. But the other thing is, if it's UK based, it's another UK based asset which is chargeable to UK based tax. Now, by having offshore based investments, they're not automatically taxed within the UK taxation system. So for someone like him, we can't stick money into an offshore investment product, not subject to UK tax. So he's not paying any tax on an annual basis. All the tax and the growth is all rolled up. He's not paying anything at all. Once he then moves into an environment that's more tax efficient, so in Dubai, they don't, as far as I'm aware, they don't have income tax, high VAT on purchases, but no income tax. So technically, he can then withdraw all of that money once it goes abroad as income. And because there's no income tax, he's paying nothing. Whereas if it was onshore, then he'd be paying tax on UK rates in the UK.
Then how does that affect you?
So for him, from this, we then go on to the other angle, which we've not discussed at all, but to do with domicile and residence. So in order for you to be liable to UK inheritance tax, as it stands at the moment, you've got to be UK domiciled. Now, the rules of domiciliary is quite complicated, but it's basically, where do you call your permanent home in the most simplistic way? And there are different ways. There's like 4 or 5 different ways to designate what your domicile is. So at the moment, if your domicile is in the UK, you're subject to UK inheritance tax. For him, he's planning to move abroad. So the domicile rules are changing from next April. They're moving from domicile to residence. So the idea under the new regime is, if his non-UK residence for 10 years is outside the scope of UK IHT. So then you've only got that 10-year tail. After that, everything is exempt for him. Move to Dubai. Yeah. Yeah, that's it. Yeah. Yeah. Got any questions? All good. Yeah.
Personal pension fund.
Mhm. Yeah.
Is it permissible?
Yeah. Yes, it's permissible. So look, it's, remember what we said right in the very beginning, like, the pension, all a pension is tax wrapper. All it is. So how is that money taxed? That's literally the only thing that it does. Now, what's inside these pots is what makes it halal or haram. Now, so when I've done my own research in terms of looking at the different pensions, so pensions, they come in two forms. You've got your trust-based schemes, master trust, Sarjan speciality. You then got GPPs, group personal pensions. As far as I'm aware, there's about 60, 70 in the UK of them in total. Now, almost all of them that I've looked at, they do offer a Sharia-compliant alternative. It's only one fund, but they do offer one. So all of them, not all of them, most of them offer the HSBC Islamic Global Equity Index Fund. So in order for you to make it compliant, you basically have got to get in touch with the platform provider and ask them to switch your fund into that. Now, and this is a discussion that we're having as part of a wider group, One of the risks of doing that for you, and I'm going to say you're 40 years of age, for argument's sake. Let's go for 40. Go for 20. Let's go for 20, right? Let's go for 20. But one of the risks of doing that, at the age of 40, right, it's okay, it's fine. Problem is, because you're 100% equities, the closer you get to retirement, there isn't a lower risk option. Because they've only got that one fund, which is 100% equities, you can't de-risk. So when you invest in a pension with an employer, they have a default fund. And what that default fund does is, dependent on your age, it does high risk to begin with. Plus you get to retirement, it gradually de-risks on its own. If you're self-selecting your own fund, they don't need to provide you that gradual de-risk anymore. So you'll basically end up being high risk up until the date that you retire and beyond. So the only way to then de-risk for you is either you transfer it to somewhere else that gradually, does it for you, maybe, if you can find someone, or you do it yourself, or you basically come to us and we do it for you. That's essentially how it is.
I'll add to that a couple of things. First of all, the options for Sharia compliant sort of pensions is sort of changing, right? So, for example, the Nest, the large one that's provided by the government, started in 2012. That has a Sharia-compliant fund. They have changed their Sharia-compliant fund to include 40% in sukuks recently, right? There's HSBC's suite of Sharia-compliant funds include now non-equities as well. So I think things are developing quite fast, basically. So that's one point. The other point is it's worth saying with pensions, the tax benefit on going in, right? So with the difference between ISAs and pensions, if you think about it, with ISAs, your income has been already taxed and it goes into the ISA. And then when it comes out as either sales, subject to capital, that would be subject to capital gains tax normally, there's none of that, right? And income, there's no tax. With pensions, right, if you're a high rate taxpayer, say 40%, yeah, then what you do is if you put 60 pounds of pre-tax, post-tax income, you're getting £100 of benefit basically, right, of money invested. What it is it's very tax efficient on the way in, because straight away you're getting an uplift for £60 invested. If you didn't put in the pension and you took as income, you get 60, but instead you're getting 100 put in your pension pot. Rough numbers, right? But yeah. So if you don't put money in a pension, then you're foregoing that uplift of 40 quid.
It's huge,
yeah, it's a huge uplift. There's not that many investments that give you 40 quid when you put in 60 quid on day one, right? And then it gets invested, and usually depending on the vehicle, the the dividends, etc., don't get taxed because it's a pension. But when you come to withdraw it by taking money out, basically, then you get taxed as if it's income, right?
Yeah, I think
so it's worth sort of understanding that. That's the difference between an ISA and a...
Also, if you have your pension with L&G or Aviva, those are the two that I know of. But if you have it with them, literally within the last 1 or 2 months, they introduced a lifestyling pension product, which gradually de-risks, Shariah-compliant, which gradually de-risks for you. They're the first two that have done it. They're using the same building blocks as what's available, but I think Shah Jahan and I, along with a larger working group, what we want to try and see is that being integrated across the entire UK with all pension providers, because it's not a complex solution, but it's something that works for the vast majority of people. So if it's one of those providers, have a look if they've got that.
We have to wrap up in 2 minutes, but I've got one question.
Yeah, go ahead.
It's a basic one for people that will see this video.
Yeah.
Can you give me in 2 minutes the top 3 advice for people that have a very basic view of to get a salary? What should they be doing? 2, 3, whatever you think. 2, 3. Quick, very simple for the layman.
First and foremost, consider paying off any debt. That's the first. So you start off with whatever's got the highest rate of interest. Your credit cards typically they have the highest, and loans and so on and so forth. I've seen sort of different rules online about 75% you use for yourself, 15% you save, 10% you put in cash or something or the other. But there isn't a hard and fast rule that works with everyone. Ultimately, you've got to ask yourself, in terms of yourself, what sort of lifestyle do you want in terms of the future? And then it's almost working backwards. I want £2,000 a month at the age of 60. Well, okay, then how much do I need to save today? You can do those calculations yourself. And even if it's ballpark, alhamdulillah, it's good enough. If you want more detailed calculations, you need to speak to an advisor. The other thing is, depending on your circumstances, think about your tax allowances that you've got. You've got your ISA, 20,000, your LISA, 4,000, plus you get 1,000 given by the government. And maximize them. Pensions, highly tax efficient. In the event of death, no one's asked me that. If you were to die with a pension before the age of 75, your beneficiaries get it free of income tax or any tax. Cash, tax-free before 75. All of it subject to value under 1,073,100. If you've got less than £1 million, your beneficiaries get tax-free. Like highly tax efficient. So consider your options.
We're at 9. Yeah, wrap it.
Excellent.
Jazakallah.
Alhamdulillah.